Welcome, learners. Today we'll see about income from capital gain. Yeah, any profit or gain arising from transfer of capital asset shall be charged to tax under the head of capital gain in the same previous year in which transfer took place. Capital asset plus transfer equal to capital gain or loss on the accrual basis. Capital asset. Capital asset means any kind of property held by the assessee, whether or not connected with the business or profession of the assessee. Any securities held by FIs which has invested in such securities in accordance with the regulations made under the SEBI Act 1992. So jewelry, ornaments made of gold, silver, platinum, or any other precious metal, whether or not worked or spun into any weird apparel, precious or semi-precious stones, whether or not set in any furniture, utensil, home appliances, or other article worked on the spin is any wearing apparel. Agricultural land. The land in India which is not situated within the limits of municipality or cantonment board. Population of the municipality or cantonment board according to the last preceding census. More than up to 10,000 10,000 to 1 lakh, 2 kilometers, and more than 1 lakh to 10 lakh, 6 kilometers, more than 10 lakh, 8 kilometers. Property of any kind held by the city, whether connected with the business or profession or not. The capital asset may be a mobile or immovable, tangible or intangible, fixed or floating. It includes land, building, plant, investments, goodwill, leasehold, jewelry, shares, and manufacturing license, etc. Any securities held by the foreign institutional investors which has invested in such securities in accordance with the regulation made by the SEBI Act, both are taxable under the head capital gain in hands of FIIs. So kinds of capital asset, short-term capital asset and long-term capital asset. Short-term capital asset means capital assets held by an assessee for not more than 36 months immediately preceding the date of its transfer. Long-term capital gain means a capital asset held by the assessee for more than 36 months immediately preceding the date of its transfer. Transfer of capital asset. This transfer includes sale, exchange of or of change or give up of the asset, the extension in any right, compulsory acquisition under any law, asset converted to stock and trade, conversion of business into a limited one, limited company, and allowing of the possession of immovable property and maturity of zero coupon bond, any transaction with the effects of enjoyment of immovable property. The difference between the long-term capital gain and short-term capital gain. It arises out of transfer of long-term capital gain. This is the rise of the short-term capital assets. Tax is 20% rate applicable on all other incomes. Cost of acquisition and cost of improvement are indexed on the basis of CII. No indexing is done. In long-term capital asset, it's required before 1/4/1981. Then the fair market value of the asset as on 1/4/1981 is taken as the value of acquisition. No such option is available to short-term capital gain. Long-term capital loss can be set off only against the long-term capital gain. Short-term capital loss can be set off against on the short-term and long-term capital gain. Certain transactions not regarded as transfer of capital asset under the patrician of Hindu undivided family, gift or will or irrecoverable, then holding company, subsidiary company, then amalgamating company, subsidiary company, a demerged company, banking company, foreign demerged company, any work of art, archaeological book, manuscript, drawing, photography, or government, university, National Art Gallery, National Museum, conversion of debentures, shares, debenture of company, transfer of land of sick industrial company, exempted is allowed for the sickness period alone. The computation of short-term capital gain is full value of consideration minus selling expenses or cost of transfer. Then we'll be getting the net value of consideration. And we have to minus the cost of the acquisition and cost of improvement for getting the short-term capital gain. Similarly, for long-term capital gain, first we have to start with the full value of consideration and we have to minus the selling expenses and cost of transfer. We'll get the net value of consideration. From that, we have to minus the index cost of acquisition and index cost of improvement in order to get the long-term capital gain. Full value of consideration means it includes the whole or complete sale of price or exchange value or compensation including the enhanced compensation received in respect of capital asset in transfer. Cost of acquisition means cost of any capital expense at the time of acquiring the capital asset, and cost of improvement means it is a capital expenditure incurred by the asset for making any additions or improvement in the capital asset. It also includes any expenditure incurred in protecting or curing the title. In other words, the cost of improvement includes all those expenditures which are incurred to increase the value of capital assets. Index cost of improvement equal to cost of improvement into index value. This cost of index value for the year in which the asset is sold divided by the CIA of the year in which improvement to the asset took place. And exemption of capital gain. Exemption of capital gain arises on the transfer of property used for the residence. The exemption under Section 54 relates to the capital gain arising out of transfer of residential house. The exemption is available only in the individual assessee. The exemption related to capital gain arising on the transfer of a residential house. Some of the conditions exemption is available if house property transfer for use for residential purpose. House property was long-term capital asset. Assets has purchased other house property within a period of 1 year or before 2 years after the date of transfer, or constructed another house property within 3 years of the date of transfer. Computation of index cost improvement equal to cost of improvement into cost inflation index for the year in which the asset is sold divided by cost inflation index for the year in which improvement of the asset took place. The important notice: if expenditure is incurred for the improvement period to 1/4/2001, it shall not be deducted. Computation of capital gain in case of depreciable assets on which the depreciation is allowed on the basis of return down value method. So how we have to do like that. Computation of capital gains in special cases. Capital gain in case of damage or destruction of capital assets when the assessee receives any money or other asset under any insurance, then such money or other asset shall be chargeable to tax under the head of capital gain. The income shall be deemed to be a income of the previous year in which such money or other asset is received. The fair market value of the asset received on the date receipt shall be to be the full value of consideration. Transfer by way of conversion of capital asset into stock in trade. When the asset is transferred in stock in trade, it is taxable under head of the capital gain. This is taxable in the previous year in which such stock is sold, otherwise transferred by him. The fair market value of the capital asset on the date on which converted into stock trade shall be the full value of the consideration. Hence the capital gain is calculated like this. Thank you.